A cautious start to the Tuesday equity trading session on Wall Street and Bay Street. Let's bring in JoAnne Feeney, who's a partner and portfolio manager at Advisors Capital Management, to talk a little bit more about the mood of the markets. JoAnne, it's always nice to see you. We are knee-deep in earnings season right now, and it does feel like the flavors we're getting from companies on how they're navigating all these macro headwinds we've been talking about for weeks is giving investors a bit more of a compass on how to move their money around. What's been your takeaway?
Yeah, good morning, John. I think we're going to see companies express a lot of caution about what's going on with earnings, with their outlook for the year. And so I think this earnings season is going to be a challenge for investors, basically to be able to look beyond the current headwinds, which are not insignificant, whether it's, the supply chain problems from China's zero COVID policy, the high metals, commodity prices, the ongoing risk of where this war is going to go in Europe. Obviously, there's a lot to worry about. And then add to that the inflation and interest rate outlook here in the U.S. and in Canada. So I think we should really expect companies to continue to be cautious in their guidance. And that's going to give investors some pause. Now, I do think there are some bright spots. Look at the tech world, for example. I think there's still plenty of multi-year, very strong demand out there in data centers, for example. And so there are some opportunities, which I think we're seeing reflected in some of the market's moves since basically mid-March, when folks started really recognizing that if they want growth, they're going to have to go find it in the areas of the market where there are multi-year drivers still in place.
This is where things get complicated for me, JoAnne, because there's a lot of people who say because of these changing dynamics of the market, you better be careful about, I hate market cliches, but catching a falling knife. If technology has taken a leg lower, but we're still looking at a fundamental shift in where the economy is going and how people are going to invest, you might be buying before we've really come to the end of the selling. So how would you counter that?
Yeah, it's always a challenge. You're asking a timing question.
Yeah.
When is a good time to get in these stocks? Do you want to be trying to catch a falling knife? And I guess it's important to step back and really look at the valuations of these companies relative to their intrinsic value. And some of the ones that have sold off very steeply, I think, are good opportunities here. And again, I think we're seeing a lot of short-termism in the market. All these really near-term risks, supply chain, near-term in that they could still last through this year, right? But for a long-term investor, it's important to recognize that there are some values that have now emerged, and maybe you won't get it exactly right. Maybe you won't be able to buy at the bottom. That's always hard to do. And for those who don't have that kind of patience, there are plenty of other opportunities in some of the higher dividend yielding stocks that offer less volatility, that offer a bit, ways to sleep better at night, whether they're a TD bank, like up in Canada, or a Cisco on the tech side that has a nice dividend, or an IBM. We're not going to expect huge growth out of any of these names, but they offer a nice dividend and a little bit less volatility.
And I saw that I just went to a theme park for the first time in a while yesterday on the weekend, and I saw Six Flags is on your list too. Why does a theme park make it on your list of names to consider?
Yeah, it's a classic reopening play, such as those things that become classics. And it's also a pretty good set of companies that do well even during tough economic times. And we know this higher inflation is going to hurt some parts of the consumer base. And so for folks that say, a full on vacation, multiple days, hotels, that's too expensive, they're still going to want to do something. And so Six Flags and its theme parks really offer an opportunity for them to get out. And so it's a reopening play, but it's also a bit of a recession insurance play. And, we think while they have a lot of debt, they're actually moving in the right direction. And we think their numbers this year are going to be pretty good, boosted by the increase in attendance that we expect to see.
Okay, so just recapping in a few different buckets there. In financials, you talked about TD Bank here in Canada, which we mentioned in our newscast, hiring some tech team members in Florida. In tech, you like names like Cisco and Broadcom, and then you've got this bucket of so-called smart cyclicals. You referenced Six Flags, and then Match is another one you're watching. What would be the areas of the market that you would be overly cautious on right now, JoAnne?
I'd be a little worried about most of the utilities at this point. And the reason is they've come up a lot. Their valuations are very high. And classically, right, people own them not for the growth because they're constrained, but for the dividends. And with interest rates rising, there's a safer way to get similar income over in the fixed income world. So these utilities have been sort of a go-to for making your portfolio a bit safer. We think their valuations have gone up quite a lot and makes them relatively unattractive. And as interest rates go up, the alternatives in fixed income could really pull those stocks back down again.
JoAnne, it's always great to get your insight. We appreciate you stopping by this morning. JoAnne Feeney joining us, partner portfolio manager at Advisors Capital Management.